Everybody get up!
Welcome back to the Lance Roberts Show podcast right here at realinvestmentadvice.com. Today, our special guest is Michael Kahn, great journalist, certified market technician, and of course, we're talking about markets. Surprise. You can get all of our YouTube videos, though, at our YouTube channel. Simply go by our website, realinvestmentadvice.com. Click right there on the YouTube tab and subscribe to the channel. But you can get access to all of our interviews and all of our podcasts right there at realinvestmentadvice.com. So, Michael, just for the break, we were talking a little bit about, kind of market trends and a little bit of overbought, oversold, because we are talking a little bit technical today about the markets, trying to help people understand how price affects things in the market. And I want to talk a little bit about the longer term picture here, because you brought something up for a moment about markets and changes of trend. And the one thing that is interesting, at least for me right now, is looking at kind of the longer term picture of the market. If we go back and kind of look at the market over the last 3-4 years, we've had this accelerated trend in the market that really, 2009, 10, 11, 12, 13, 14, the markets were rising. Of course, we had quantitative easing 1, 2, and 3. We've had, a lot of central bank action, lots of reasons why the market was just advancing for the last several years. But really beginning in 2018, the markets have become very choppy. They've just gone sideways. And of course, the question now becomes, is this a potential change in the trend of the market currently that we're expecting? I mean, we do have valuations that are fairly elevated. There are some, we're very long in the current economic cycle. We're very long in a bull market cycle as well. So is this potentially a change in trend that we're watching here? Or is this a little bit like we saw in 2015, 2016, which was kind of more of a pause that refreshes the bull market?
Well, I think it's actually a little of both. The argument that we're in the 10th year of a bull market or whatever the number is,
right.
Some people disagree with that, saying that the latest leg of the bull market actually started in 2016. So we're only 3 years into a bull market. The argument for that is that it came off of a long correction. Mm-hmm. It doesn't have to be down necessarily, but a sideways correction, and then it took off again. So that's your bull market in some people's view. I think it did start further back. So I'm in the camp that it's kind of late in the game, but late doesn't mean it's ending anytime soon. And the question, I think, was how do you know the difference between a pullback and a reversal?
Correct.
And the answer is you don't as it happens. If anyone thinks they can nail the top, they're wrong. They may be looking at a very short-term chart, so it looks like they nailed the top. Mm-hmm. But I don't think an investor or me can look at the high and say that was it, we're done, unless there's a real dramatic, reversal in the market, like at the end of the tech bear market,
right.
After the tech bubble burst. I mean, there were some pretty obvious signs that it was a bottom, but that's a bottom. Tops are different than bottoms. The expression is bottoms are events, but tops are processes. So that's what you got to look at here. So the second part of the question, I guess, is does this look similar to the previous top, which I guess would have been in 2007-ish? Mm-hmm. It kind of looks a little bit like that, but because of all the meddling from the outside of the market, meaning the Fed, things have gotten so distorted.
Meddling, code word for Fed.
Not a fan, by the way. But I think everything got distorted. I really think we should have seen a bearish, cyclical bear within the past couple of years, and that was just staved off by all this free money.
Do you think that potentially, and that's kind of, and I agree with you on that point, and my concern is that we have continued to kind of stave off what would have been maybe a kind of a normal, healthy correctional process, which potentially makes whatever correction does come eventually potentially worse, because we didn't allow normal excesses to be, mean reverted, so to speak. And typically when we do these kind of artificial interventions and inflations, they wind up leading to bigger corrections than we would have had otherwise. Do you disagree with that?
Well, now I'm going to be your foil.
Okay.
You could argue that since the peak in very early 2018, it's been sideways and that's your correction. And you can have a correction in terms of time, not necessarily in price. And I think we had both. But I think we have worked off a lot of the excesses of the previous cyclical bull run, 2016 to 18. That was a pretty sharp run.
Yep.
Very low volatility. Then you move to higher volatility, and we're moving sideways with big swings. So you could argue that this is a correction that's worked off a lot of those excesses. I'm not going to argue about valuation of the stocks. That's not my thing. You mentioned they were a little elevated, and I'd believe that, but can they get even more elevated? Will the earnings come in? Will the earnings come in to support the ratios after the fact? I don't know that.
Right.
So I think that we're very late in the game. There's still some more to go here. I can't say it's going to last a month or 6 months. It's going to last till just before the next election cycle when they start goosing the market again. I don't know that, but I think that all you can do is control your action. And I think the action you have to take now is stick with it, not be blind to it, not what's going on. Just don't be scared out of the market. I think we got a little more upside to go. I'm not going to speculate on how much.
Well, look, and this is where I want to change our conversation a little bit, Michael, because, I manage client money, and their primary concern is not to lose a lot of capital. And mostly it's interesting is that the clients that we work with mostly at RIA Advisors are individuals that are very close or in retirement. And the majority of those individuals have gone through 2008, right? They have seen what a bear market can do to portfolios and to savings and to investment. And it's a very different attitude that they have versus what we read in the media and what's said on kind of financial television, et cetera, which is just buy and hold. The markets go up over time and you'll be fine as long as markets keep going up. But when it comes to investors, kind of managing their portfolio over time, there is a point to managing risk. And I kind of want to let you just talk for a minute here about, putting to work, because technical analysis kind of gets a bad rap in the market. Everybody just, technical analysis, it's timing the market. You just can't be all in and all out all the time. And it's just voodoo for the most part anyway. But that's really not what technical analysis is, and it's not really how it works within a portfolio. Yes, there are people that do day trade. Yes, there are people that are all in and all out of markets on a regular basis. But for an investor that's trying to manage and grow their assets over time, technical analysis can provide a tool to help manage the risk. And I was wondering if maybe you could talk a little bit about that.
I think the biggest thing that technical analysis can tell you is what's the trend? What's the major trend in the market? Are we in a bull market or a bear market? I think you nail that and you get half the battle right there. And then you could work your strategies like, okay, I don't have 5 years to retirement. I got 20 years to retirement. I think overall we're still in a bull market, near the end, but still in a bull market, and that's just how I would approach it. I'm not going to say indicators and all the other whiz-bang things that we like to talk amongst ourselves about, but the average investor doesn't care about that. They just want to know, should I be in or out? Not 100% like you said, but should I be looking to stay invested or start taking it out?
Yeah, exactly. And when we're looking at when we want to identify trends, and when I'm looking at the trend of the market, would you recommend using daily analysis or weekly or monthly to try to smooth out some of the volatility? What's your preferred method for looking for trends?
Well, the answer is not satisfying because it depends on who you are and what your goals are. I'm preaching to the choir on that one.
Yeah.
In my personal situation, because I do write mostly for retail investors, I look at a daily chart because I want to see the wiggles. I want to see how the price got to where it is now. Not just it was up 5 points today, but it was up 20 points in the middle of the day and it ended up only 5 points. That has meaning to me. But I look at probably a year's worth of data just in that view, so I get a near-term picture. And then I will flip to a weekly chart and look at 3 or 4, maybe more years, because I want to know overall the major trend of the stock or the market, the index, the commodity, whatever I'm looking at. I need to know how it got to where it is, because that gives me information on the likely next step for it.
So we're going to take a quick break, Michael. when we come back, could you maybe walk through a little bit about some tools for our viewers to say just to get started, and kind of just some basic kind of steps to say, look, if you want to apply technical analysis to what you're doing to help you manage your portfolio better, here's some basic steps to get started. Kind of just a quick technical class 101. What do you think?
Sure.
All right, we'll do it right back when we come back with Michael Kahn right here on today's Just the Lance Roberts Show podcast, right here at realinvestmentadvice.com.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.